In this video, we are going to talk about Peter Lynch, how to invest for beginners. So before starting this video, please like this video and subscribe to our channel for the future updates. No modern-day investment sage is better known than Peter Lynch. Not only has his investment approach successfully passed the real-world performance test, but he strongly believes that individual investors have a distinct advantage over Wall Street and large money managers when using his approach. Individual investors, he feels, have more flexibility in following this basic approach because they are unencumbered by bureaucratic rules and short-term performance concerns. Peter Lynch's approach is strictly bottom-up, with selection from among companies with which the investor is familiar, and then through fundamental analysis that emphasizes a thorough understanding of the company, its prospects, its competitive environment, and whether the stock can be purchased at a reasonable price. His basic strategy is detailed in his best-selling book, One Up on Wall Street, Penguin Books paperback, 1989, which provides individual investors with numerous guidelines for adapting and implementing his approach. His most recent book, Beating the Street, Fireside/Simon & Schuster paperback, 1994, amplifies the theme of his first book, providing examples of his approach to specific companies and industries in which he has invested. These are the primary sources for this article. The philosophy: invest in what you know. Lynch is a story investor. That is, each stock selection is based on a well-grounded expectation concerning the firm's growth prospects. The expectations are derived from the company's story, what it is that the company is going to do, or what it is that is going to happen to bring about the desired results. The more familiar you are with a company, and the better you understand its business and competitive environment, the better your chances of finding a good story that will actually come true. For this reason, Lynch is a strong advocate of investing in companies with which one is familiar or whose products or services are relatively easy to understand. Thus, Lynch says he would rather invest in pantyhose rather than communications satellites, and motel chains rather than fiber optics. Lynch does not believe in restricting investments to any one type of stock. His story approach, in fact, suggests the opposite, with investments in firms with various reasons for favorable expectations. In general, however, he tends to favor small, moderately fast-growing companies that can be bought at a reasonable price. Lynch's bottom-up approach means that prospective stocks must be picked one by one and then thoroughly investigated. There is no formula or screen that will produce a list of prospective good stories. Instead, Lynch suggests that investors keep alert for possibilities based on their own experiences, for instance, within their own business or trade, or as consumers of products. The next step is to familiarize yourself thoroughly with the company so that you can form reasonable expectations concerning the future. However, Lynch does not believe that investors can predict actual growth rates, and he is skeptical of analysts' earnings estimates. Stalwarts: large companies that are still able to grow, with annual earnings growth rates of around 10% to 12%. Examples include Coca-Cola, Procter & Gamble, and Bristol-Myers. If purchased at a good price, Lynch says he expects good but not enormous returns, certainly no more than 50% in 2 years and possibly less. Lynch suggests rotating among the companies, selling when moderate gains are reached, and repeating the process with others that haven't yet appreciated. These firms also offer downside protection during recessions. Fast growers: small, aggressive new firms with annual earnings growth of 20% to 25% a year. These do not have to be in fast-growing industries, and in fact, Lynch prefers those that are not. Fast growers are among Lynch's favorites, and he says that an investor's biggest gains will come from this type of stock. However, they also carry considerable risk. Cyclicals: companies in which sales and profits tend to rise and fall in somewhat predictable patterns based on the economic cycle. Examples include companies in the auto industry, airlines, and steel. Lynch warns that these firms can be mistaken for stalwarts by inexperienced investors, but share prices of cyclicals can drop dramatically during hard times. Thus, timing is crucial when investing in these firms, and Lynch says that investors must learn to detect the early signs that business is starting to turn down. Turnarounds: companies that have been battered down or depressed. Lynch calls these no-growers. Examples include Chrysler, Penn Central, and General Public Utilities, owner of 3 Mile Island. The stocks of successful turnarounds can move back up quickly, and Lynch points out that of all the categories, these upturns are least related to the general market. Asset opportunities. Companies that have assets that Wall Street analysts and others have overlooked. Lynch points to several general areas where asset plays can often be found: metals and oil, newspapers and TV stations, and patented drugs. However, finding these hidden assets requires a real working knowledge of the company that owns the assets, and Lynch points out that within this category, the local edge your own knowledge and experience can be used to greatest advantage. Analysis is central to Lynch's approach. In examining a company, he is seeking to understand the firm's business and prospects, including any competitive advantages, and evaluate any potential pitfalls that may prevent the favorable story from occurring. In addition, an investor cannot make a profit if the story has a happy ending, but the stock was purchased at a too high price. For that reason, he also seeks to determine reasonable value. The price-earnings ratio relative to the industry average. Comparing a company's price-earnings ratio to the industry's may help reveal if the company is a bargain. At a minimum, it leads to questions as to why the company is priced differently. Is it a poor performer in the industry, or is it just neglected? The price-earnings ratio relative to its earnings growth rate. Companies with better prospects should sell with higher price-earnings ratios, but the ratio between the two can reveal bargains or overvaluations. A price-earnings ratio of half the level of historical earnings growth is considered attractive, while relative ratios above 2.0 are unattractive. For dividend-paying stocks, Lynch refines this measure by adding the dividend yield to the earnings growth. In other words, the price-earnings ratio divided by the sum of the earnings growth rate and dividend yield. With this modified technique, ratios above 1.0 are considered poor, while ratios below 0.5 are considered attractive. Ratio of debt to equity. How much debt is on the balance sheet? A strong balance sheet provides maneuvering room as the company expands or experiences trouble. Lynch is especially wary of bank debt, which can usually be called in by the bank on demand. Net cash per share. Net cash per share is calculated by adding the level of cash and cash equivalents, subtracting long-term debt, and dividing the result by the number of shares outstanding. High levels provide a support for the stock price and indicate financial strength. Dividends and payout ratio. Dividends are usually paid by the larger companies, and Lynch tends to prefer smaller growth firms. However, Lynch suggests that investors who prefer dividend-paying firms should seek firms with the ability to pay during recessions, indicated by a low percentage of earnings paid out as dividends, and companies that have a 20-year or 30-year record of regularly raising dividends. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.